My name's Louise Bunting. I've sat on both sides of the panel. I've been CIO for a hyperscale builder and operator, and also worked on the client side from an IT perspective. I've actually worked for Ashley, when he was at UBS, which was fantastic, and I loved it. I'd like my panel, if they wouldn't mind, to start from right to left, and just introduce themselves, please. Arnaud.
Thank you, Louise. Arnaud Jaguin. I'm a managing director for Triple Point, and I manage a fund called Digital 9 Infrastructure. So obviously, specialist fund into digital infrastructure, very strong focus on sustainability. That's in the name. We are named after the UN Sustainability Goal number 9 about sustainable infrastructure. We have 2 missions. First, obviously, we want to make money too, but the 2 overarching missions are about decarbonizing digital infrastructure and also bridging the digital divide. We've invested 1.2 billion pound since IPO in 2021, and we've invested into 4 asset classes: fiber, wireless infrastructure, towers and stuff, subsea cables, and data centers, including Verne Global in Iceland, Ficolo in Finland, and Volta in Clerkenwell, close to here.
My name's Sam Anthony. I work at 91, which is an asset manager. The manager's about 130 billion pounds. It's from fixed income to equity. I'm specifically on the sustainable equity team, so we take a kind of look at this kind of space from a public listed equities perspective.
Hi everyone, I'm Zahl, Limbuwala, operating partner at DTCP Capital. We're about a €3 billion fund invested in data centers, networks and towers.
Hi, Derek, Andget Limited, boutique advisory and consultancy to the data center in industry, from funding to building. That's from the business case, country site selection, and the strategy to build and deliver a project. Was a former board member of Green Mountain, from pain point to selling. Also was Yahoo's EMEA data center development guy, and worked with a number of funders who want to know, what is this data center space? How do I get the ROI? And what is the marketing and sales tactic to make that happen? And why do buyers buy what they buy?
Thank you. So I'm going to direct the first question to Zahl and Derek. When I've dealt with data center project financing previously, it was made clear to me by investors that sustainability was important to attract those investors. Do we now believe that it's a mandatory aspect to the build now and operation of the site, that we have sustainability measures in place?
Sure, I'll go first. So, short answer, I think, is yes. Speaking from a DTCP perspective, it's absolutely core to what we look for in terms of the long-term viability of an investment, of a platform, of an asset, or a portfolio of assets. And I think, while, actually I've spent most of my career on the operator side of things, on the portfolio side of things, so it's nice to see the workings, if you like, behind the scenes of now on the investor side. I think that change perhaps is more recent than some might realise. I think there was lip service earlier on, but there is real material incentive, let's say, across the board to ensure that is the case.
Yes, I actually would agree with Zahl. If you look at maybe 5+ years back, the green element was a little bit of lip service, but now when you look at the RFPs and the RFIs that come into co-location, it has moved from what have you got that is green and sustainable into what are your metrics. So it's actually turned into a business case to actually win. It's become a competitive edge. The greener you are, the more chance of a win you actually have. And what you're seeing with corporates, you're seeing them say, we have in their annual report, we have reduced our carbon tonnage by X because of going from on-premise inefficient into cloud. So you are seeing these business drivers to actually move. So in answer, it's serious now, and it's a game-changing business winning. Financial institutions, they will not go through approval process to the IC board without a proven KPI sustainable element.
So just on that piece, actually, I know that I find it very complex understanding what a sustainable investment is. Do we think that banks and investors are really clear now what they class as sustainable? I don't think, Sam and Derek, would you kindly take that?
Yeah, maybe if I start. So I think we look at it from a kind of our kind of most stringent regulation for publicly listed equity side is EU taxonomy components and revenues align with that. And obviously there's a data center focus on things like, you know, global warming potential of the refrigerant, which we kind of have to look at to then make sure it's a kind of sustainable investment in quotation marks. But I think that's quite nuanced, quite specific, arguably hard to kind of specify, especially when you're taking a slightly higher level that we may be taking on the public listed side. But the kind of thing we look at that maybe goes beyond that nuance is what we call carbon avoided, which is also scope 4. So effectively it's that relative saving, you know, moving to the cloud versus on-premise, whatever it may be, avoiding that carbon. We actually try to define our sustainable investments based on that carbon avoided number because it's demonstrating how you're contributing to kind of a net zero world, and our focus is on kind of structural growth linked to decarbonisation. I think that's a good way of demonstrating that, you know, your sustainable investment and you're contributing whatever operation that you're running. So I think that can be a really helpful way of thinking about it. I think just to quickly take this opportunity to, I guess, highlight it as well, that a lot of the focus is obviously already on climate, and there's task force for nature-related disclosures coming down the pipeline. And when we look at companies, you know, the big software companies, their biggest nature footprint is going to be on the data center side. So it may not be that material relative to climate, but it is definitely going to be something that people are thinking about coming down the line.
Yeah, and in answer to your question about sustainable in investment and the definition, in 2021, UK government produced a document called A Roadmap to Sustainable Investing. And that gives a clear indication of the taxonomy of what it feels is the right measures to actually take. And there's some KPI measurements within that document, and it's a downloadable from UK Gov piece, and I would advise you to have a very close look at that, because I think the UK was more at an EU level before the B word, was kind of leading that charge into the taxonomy of it. And if we go into that change, it absolutely had that investment had to have climate mitigation, climate change adoption, protection of water, the ecosystem around that, the pollution element, again, metrics, circular economy, something that we should be pushing a lot more, you know, the whole macro view, a whole cycle from the raw material in the ground to the disposal of circuit boards, and the protection of biodiversity. So there are metrics already beginning to come out now, but I think that's definitely one to actually look at. And if you look on the financing point of view, you used to be able to get debt-funded loans, which were called green loans, and that was based around the fabric of the building. So a colo company could get a loan because they had a good PUE or a good metric. But you're seeing now is what's called SLL, which is sustainability-linked loans, which are about the metrics of the operation of the facility itself, and they're KPI-led. So I think we are moving in the right space.
Yeah. With stricter EU regulations coming in, what do we think are the minimum standards? And also what could be the exemplary standards? So you've got two ends of the scale. And if the panel could also just explain, what happens if we don't do sustainability measures on assets? Will they potentially become stranded? Arnaud and Zahl, would you mind answering that question?
I'll go first, maybe.
Go.
I know you have more stuff to say. So as an investor focused on sustainability, we are obviously very mindful that we invest in the right facilities. That's why we invested in Iceland. We were also quite realistic and pragmatic around how taxes on resource intensive it can be to produce everything we would like to see. On a lot of the projects we look at, they are quite small, and so we really have to be realistic here. So at the very least, we would expect compliance with the regulatory frameworks, some level of transparency on reporting, PUE, CUE, some water usage effectiveness, ideally, some carbon emission data, ideally scope 2, definitely scope 2, but ideally scope 3. And also, so in the terms of exemplary, we would probably need some kind of net zero roadmap that is already in the data room or available. And also, we would be looking at some level of energy efficiency innovations. So be it liquid cooling or some use of artificial intelligence around the usage of power, something that can help us drive towards net zero.
Maybe to be a little bit more controversial, I've been, like a lot of people in the audience here, coming to these events and speaking about this for, it feels like 20 years already. And the reality is the data centers look pretty much the same as they did 20 years ago. And, while there have been significant improvements, they're still far from what they should be and could be. So I think rather than talk about, what the minimum requirement is, I think we have to figure out what are the barriers to a fundamental change, right? Because if we're talking about anything in terms of having a chance against climate change, we need a fundamental change, not an incremental change. However, there's, and you could look at the last session, the last panel, Ashley mentioned one of the issues, which is the mismatch in technology lifecycle and contract lifecycle between the data center infrastructure and the IT within it. There was, some, I guess, a tough question around why is there not more adoption in immersion cooling, and why are we still behaving rather absurdly by trying to cool, servers and network equipment using air. And whether it's regulation, whether it's technology lifecycle, all of these different pressures still haven't really amounted to enough to get the industry to adopt some of these fundamental changes. Actually, I think with the advent of what I believe we're going to see with AI and the impact in terms of how that will really accelerate change from a technology perspective, I think we'll be forced to adopt some of these technologies. Immersion cooling is a good example. And again, the regulation, 10% of heat reuse in Germany, nice start, nice thought, but really the challenges that the planet has, that we have, a lot of those could be, that data centers could be a big part of the solution to, right? The grid congestion, the transmission issues, having the ability to store energy. Okay, we can only store 2 to 4 hours of energy right now in a data center, so long-term energy storage is still a challenge. But again, having those big DNO connections all over the place for these data centers, a lot of what we could do is prohibited by the SLAs. There was a question about that. The customer saying, I must always have, I can never have risk. I don't want you sharing my UPS batteries. I don't want this, I don't want that. That's the part we have to unlock to actually make a difference here. Sorry, bit of a tangent, but I felt that was probably a better answer than what's the minimum.
No, I think, yeah, I mean, really valid point. Sorry, Derek,
Thank
do you
you.
want to speak?
No, I
Go for it.
Actually think
One fan.
if you
Two fans. Sorry.
you asked about a standard, like a minimum standard. So I think EN 5600, it's a 6-part segmented standard from what the data center is, to power use, to operations, blah, blah, blah. So if I was to pick one, I would say look at that. It's a good lesson. I think John's in the audience. I think you've been involved in that to a certain degree. So I would definitely pick that. But to pick up on Zahl's point, we need to think real macro wide. You know, we're not thinking anywhere wide enough. We're thinking building and to the rack, inside the rack. We're not thinking about country, applications, millisecond need, location, as on the last panel. We're not thinking bold enough or broad enough as a sector, because it's been very much an engineering-led sector, now getting a politically led, results driven for the wider good for everybody and everything now.
I know we were doing some really interesting things as one of the big cloud providers, where we're exposing all of our electrical measurement data so they could move workloads across continents. And that was basically from a commercial perspective exposing all of our SLAs, so we had to give them all our data, but equally they were using that data to actually influence what's happening from an IT layer, and yeah, that's progressive, but from a business perspective, yeah, quite scary, because they know when you've got a problem. Just moving on to greenwashing, and what I'm going to direct this to Sam. What do you think DC operators need to put in as a minimum to avoid greenwashing and being accused of?
Yeah, so I mean, I think the first thing, as we've already heard today, scope 1, 2 and 3 reporting is pretty essential. And I think on the scope 3 side, purchase goods and services and use of sold products are the key categories. There's probably other elements that are useful, and I think the closer you can get to kind of a full 15 categories being reported, the better. Obviously, all of them won't be relevant, but if at least if the key 2 are there, that's really helpful. And I think again, kind of, I think it was mentioned earlier on the panel that there's a progression from kind of assumptions going into these calculations to actual data being used, and that kind of progression to just making sure that evolution is happening is really useful. I don't think there's anything wrong with assumptions, and ultimately all scope 3 numbers are going to be revised higher over time as people actually understand the numbers that go into them and people start reporting, but just having an initial kind of stab at it and being transparent about how those numbers are calculated is an extremely useful kind of data point to have from an investor perspective. I think, you know, in regard to that, we kind of ask all our companies to report to CDP, formerly the Carbon Disclosure Project, because they provide the best transparency around all sorts of carbon data. It is a pain to fill in. We filled it in ourselves, but it does provide that level of transparency that I think is really, really important. And I think on the transparency point as well, I kind of already mentioned the carbon avoided point, and there's lots of discussion around greenwashing with those kind of numbers. And again, I think if we don't report it, you kind of have no idea. So it's you know, you just don't understand the impact, the positive impact that, you know, you guys are providing unless you report that number. There are assumptions that are going to go into it. It's going to be probably wrong at the end of the day, but unless you actually try it, then there's, you know, we're not going to get anywhere. And I think with that kind of reporting number, and to avoid that greenwashing risk, again, it's about transparency. There are assumptions that will go into it if you provide those assumptions to people so investors can just understand the context that's going around it, then I don't think there's anything wrong with that. And again, it's getting to the point of demonstrating what your kind of impact is. And I think the kind of final point that I would make is just when those emissions are set and disclosed, having things like a science-based target is really helpful. You know, we again are speaking to public listed companies, so we may be speaking to an Autodesk or something that does construction software, but asking them to put a science-based target in place, which they do have, will obviously come down to the data centers ultimately, because they'll need, you know, everybody else to commit for them to get the science-based target approved. I think having a robust kind of going through that robust science-based process is extremely helpful, and ultimately investors, you know, these guys are specialists more so than I, but unless investors can kind of see the thought process and that it's kind of been approved by a robust body, it gets quite hard of understanding that roadmap. And I think, again, when it comes to setting a target, actually demonstrating that it can be done, so it's not back-end loaded with a bunch of offsets or whatever it may be, just demonstrating that there is a clear plan to doing it, there's a clear roadmap to follow, and sort of giving investors confidence you're actually kind of implementing the actions that are there.
Thanks, Sam. Just on offsets then, JP Morgan has just invested 200 million in a carbon removal scheme that's based on just on their Scope 2 emissions offsetting. It's estimated if they'd looked at Scope 3, they would have had to have reserved 92.5 billion, which would have brought them into a loss last year to do their Scope 1 to Scope 2 and Scope 3 offsets. Arnold, do you think offsetting is actually, how do you as an investor make sure that the overall liabilities are understood if someone's committed to carbon net zero and they're offsetting everything? And do you think it detracts actually from removing carbon, which is really the ultimate goal, not offsetting?
Yeah, thank you, Louise. Very good question. I don't want to say anything bad about JP Morgan because they're my broker and they would hate me if I did. But at Digital 9, we don't really believe in carbon offsetting. We don't do it. We are mindful, and when we see it, we know what's going on, so we discount it. But the question is, what is the use of carbon offsetting? And if it's a way to just not, if it's a substitute for actual carbon emission reduction, then it's clearly a no for us. I mean, it is definitely a distraction, as you said, and even harmful to the industry. So the priority should always be to decarbonize properly, and work on actual reductions, work on transparency, on proper reporting, and make sure everyone is accountable to real carbon emission reductions. And offsets should just be used as a complement in case you need a little bit more to hit your net zero targets, for example. As long as you are transparent with it, as Sam hinted earlier, that's fine, right? But it should definitely not be the core strategy here, and it's just a complement. And obviously, you also need to look at the quality of the offsets. You can't go for anything.
Yeah. Okay. I don't know if we're doing questions. We're done. We're efficient. Making up for you guys chatting. Oh, sorry, Derek.
Yeah, no, well, I was just going to say, I kind of think there's an offset to the greenwashing viewpoint, which is what does ICT do for everybody? And it actually reduces carbon. If you look at those traditional industries which are using ICT from, say, print, if you look at the cost of printing, getting your paper to the door and vans driving around, posting letters in the door, or buying a CD, blah, 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 ICT has a place to offset carbon load. And if you look at studies done by the GESI and Ericsson, they are saying now global carbon has reduced to what it could have been by 20% because of ICT. That's globally and everything.
And I get that, and I think no one dismisses the fact that technology is going to help deal with the, carbon-related issues. I think the purpose of this panel was to see, from a financial perspective, are there preferential rates that you're going to get? Are you getting better returns for sustainable assets? from a financial gearing perspective, if you're a data center operator now and you've got a carbon net zero strategy, how much more investable are you going to be? How much more from a refinancing perspective is it going to be? Is it really going to make the level of difference that it should do? And are the banks getting behind it to drive the industry towards zero carbon? Zahl, you're nodding?
Yeah. Well, first of all, if you don't have a strategy that's coherent and you're actually able to demonstrate you're going to action it, it's not just, oh, I've picked 3 KPIs and I'm good. If you don't have that, then you're not investable, really. Does it make a difference in terms of, for example, the rates? Yes. I mean, it's still small numbers, right? So the sustainability linked loans and so on, they're all there, but it's small enough that you could say, well, the cost and effort of doing it versus the small number of basis points improvements, I'm not sure it's necessarily going to motivate anybody one way or other at the moment, but it's heading in that direction for sure.
Okay. And also because of the competition in the market, it is something that needs to be seriously considered. So I'm assuming you, from a Digital Nines perspective, how many assets are you looking at and how many things are you dismissing off your books because it's not in the right location or it doesn't have the right type of profile? How are you doing it from a selection perspective?
Well, now we've already selected, so we are looking at stuff which complements well our asset base.
Right.
The one thing I wanted to tell you is a perspective from the manager of a listed fund. So I talk to shareholders all the time, and I don't think we're there yet necessarily in terms of scrutiny. Some shareholders are more focused on sustainability, on net zero, and ask us for a lot of incremental reporting. But I would say the majority do not question it so much. However, there is clearly a trend upwards, and I can see a future in which, like in a few years' time, if we meet our net zero targets, for example, same way we would miss our return targets, we would get punished by the market and share price would go down, but not yet.
Well, there's an argument that says that someone like Google, for instance, who've got significant capital at work, right, are potentially doing, their capital is potentially having a higher carbon footprint than their actual data centers, right? So, is there that type of awareness, do you think, from a finance perspective, from like your $3 billion fund, how specific are they that they want to make sure that the assets that you're investing in have got this strategy? Is that a criteria?
Yeah, certainly with the LPs that we work with, they're more or less all on the ball and actually, scrutinise us quite heavily and actually have, in many cases, the expertise on their side to dig into the details. So I don't know, I can't speak obviously for any other fund, but certainly LPs we work with, there's a good understanding and a lot of scrutiny.
Okay, have we got any questions from the audience? We've got 5 minutes. Oh. I'll just pass the over to Colm.
Yeah, I have a question with regard to verifying that the project or the investment is going to be sustainable. And I think it was Sam talked about, they have a bunch of metrics and we look at those metrics and we're happy. I think often what's lost is that when you invest that money over a period of time, they've made a commitment to get to net zero. I think the metric is not the key. It's how's that pathway and roadmap to net zero. What are you guys looking at that to figure out what have they built in to get to net zero? Not the goal, but the journey.
Yeah, I mean, I think it comes back to that science-based target point. To have that, we have the goal of every investment has to have a science-based target, by 2030. So if that science-based target isn't there, that process and that incremental step wouldn't be there. So that, I mean, in itself should provide that incremental step of how you understand it, and then you have to keep people accountable every year. We try and model out emissions of what we expect to be in line with their pathway. If they've told us they're going to reduce emissions in their purchased goods and services by 15% by 2023, we have some accountability there. It's still not detailed enough in terms of allowing us to understand actually what does that mean? Does that mean you're using zero carbon steel or whatever it may be? So I think there's more transparency to come, but I think people signing up to the kind of targets that aren't just net zero which everybody can say quite quickly and then figure out in 5 years' time. A science-based target, you can't get that without that. You have to go through a relatively rigorous process.
Which
to get
includes
it.
preparing the journey.
Yeah, exactly.
So there's going to be auditing, right? You're going to have
Yeah.
to audit at some point and make sure they're actually doing what they say they're
Yeah.
doing.
Yeah.
Okay, I've got another question.
Appreciate it. Everyone knows DCs offer mission-critical services, but let's jump into the theoretical. Let's say we've lost the climate battle. How much focus are investment firms placing on climate adaptation instead of the net zero journey?
Did you get that?
I missed part of that.
Yeah, so let's say we're screwed, basically.
Right.
Lost the battle. How much is a climate adaptation part of your portfolio strategy? Is that coming into the thought process at this stage, or do you feel like we've still got a shot at the...
Well, I say we've still got a shot, but it is going to take some fundamental changes that I mentioned earlier. So I'd say at the moment we're not looking at adaptation specifically.
I mean, on that front, there are definitely, like the City of London, and there are organisations out there that are fully invested in climate adaptation right now.
But transition risk is a mandatory policy that the banks are going to implement under CSRD. And transition risk includes, what are you going to do to counteract climate-related issues?
There's a positive here, is that if you look at strong companies with strong ESG, they outperform companies without an ESG policy. And since 2020, since COVID, that's now 8 out of 10 companies with a strong ESG policy are more profitable than those that aren't. So I come back again to capital to get that investment and funding. You won't get the funding unless you have metric-based.
It should make business sense, right? It should be a business strategy.
Yeah.
Right, I've got time for one more question.
I have the time now. I really appreciate it. Thanks. My question was, so my question is really about what was mentioned before for science-based targets, and given that the Science-Based Target Initiative validation is really seen as an external stamp of validation and credibility and transparency. But at the same time, we also know from experience that the Science-Based Targets Initiative is very time constrained, and in many cases there are methodological sort of dead ends when it comes to validation. So I just wonder, do you have any thoughts about that when it comes to, let's say, the validation of a net zero commitment and associated roadmaps? Thanks.
I think what I'd say on that is that the validation is extremely helpful, and and verifying that someone's checked it. But I think if there's problems of validating it, or problems kind of getting it through the science-based process, publish it, demonstrate the kind of detail and the work that has gone into your disclosure so people can read it and understand it. People are looking at it more and more. People are taking carbon risk and climate into account. I think they will increasingly read those disclosures. So I think if you provide that, whether it's science-based target or not, if I can understand it and kind of get a sense of the trajectory you're doing, and then you prove that your emissions fall in the following year, that kind of does more than a science-based validation can do.
And I think we're going to move on to that from a regulation perspective. Let's give our panellists a big round of applause.